both consumer surveys and market-derived expectation measures. And so the argument is we'll see it coming and the Fed will be able to stop it before it gets here. A couple of things to keep in mind is that it often hasn't been the case. I mean, for instance, consumer expectations have tended to be much more sticky than what we see in the actual inflation. For instance, when we actually saw deflation in 2009, there was no consumer expectation of that. And again, you also see it on the flip side. If you go back and you look in the 70s and 80s, much of the very high rates of inflation were not expected until they actually were upon us. So again, I caution whether we think we can see it coming and avoid it before it gets here. But moving on to, we are actually, after all, talking about the global status of the dollar, and so trying to couch that in an extent of, how important is the dollar, and what we have here is some measure of central bank holdings, and so to give you some sense of how important the dollar is, most recent numbers are a little bit less than 2/3 of central bank holdings around the world are in dollars, and again, the central bank holdings tend to reflect private holdings as well, because of course you might have central banks trying to facilitate trade, and you can see that in some sense the dollar decline has already happened back in the 70s, and right at the beginning of the sort of end of the Bretton Woods period, it was much higher. You had close to 85% of dollar holdings in, for instance, the early 70s. But you also see currencies come and go. For instance, I think one of the interesting things is to look back pre-World War I, where the sterling, the British pound, was the dominant currency. But again, even at that time, it was less than half of holdings. People would sort of forget that at that time, even the French franc was an important currency. And we've seen the growth of the euro in this regard sort of take over some of that role. But again, some currencies have come and gone. In the 80s and 90s, the yen seemed to build in importance, and then has declined very much as importance. But you see a continued role for the dollar. And again, we're going to talk about what that might look like going forward. Going back to my earlier comments about what are the basic uses of a dollar, keeping in mind the medium of exchange, the broader the use of the dollar, whether it's by central banks or whether it's by private market participants, is going to increase the demand for the dollar. In a lot of the demand for the dollar is outside the U.S. In fact, almost 2/3 of all $100 bills are held abroad, and of course this varies considerably. The numbers I put are just a selection of some of the countries where, for instance, in Argentina, and these are per capita average holdings. So of course, this doesn't mean that everybody on the street holds this. It means that there are probably a number of people who hold a whole lot of currency and many who hold none. And of course, some of this is driven by the extent of black markets and those economies, which tend to be dollar denominated around the world. So for good or bad, one of the drivers of demand for U.S. currencies, of course, is the drug markets and other black markets around the world. We still seem to be the currency of choice among drug dealers, if you will. As I mentioned earlier when I talked about vehicle currencies, a lot of trade is driven. Of course, and again, you think about a demand for currency driven by medium of exchange, and it really is driven by how much the export share and how much the import share. And just to give you a sense, I've got a few countries listed. In the first column this is the amount of their exporting that's done in dollars. The next column is the amount of their importing that's done in dollars. And to give you some sense of how important this is also the percent of their exports to the U.S. And again, you can see in certain countries like South Korea, over 80% of their exports and imports are in dollars, but only 10% of their exports actually go to the U.S. So a tremendous amount, particularly trade in Asia, is denominated in dollars, is settled in dollars, even when it's not necessarily intended to go to the U.S. And this is something where I think when we come and talk about the role of China potentially, really you could see the biggest change, because ultimately, if China is going to grow at the expense of the U.S. or the dollar, it's going to come in the area of trade in Asia, and currency trades that are settled in dollars now could be settled in something else. And again, I'm going to come back to talk this a little bit more, but this is going to be the margin upon which we would likely see a tremendous amount of change. We've also seen a tremendous amount of change in global currency, from going to the differences in terms of whether your currency is pegged or whether it's floating. And to give you just if those terms don't seem obvious, a hard peg is the currencies that are, for instance, like the Hong Kong dollar is set as a hard peg to the U.S. dollar, so it moves in lockstep with the U.S. dollar. One can think about the transition to the euro area as essentially a growing of a peg. Right now, Italy and Greece are pegged to France and Germany. And of course, floating currencies, most of the world have moved mostly to floating currencies, except for those who have some sort of managed peg. Pretty much among advanced economies, you don't really see much of a managed peg in that real way. It either is a hard peg or a floating peg. And this will come back in terms of the demand for currencies, because of course to manage your currency, to manage a peg, often requires countries to go back and forth and intervening in the currency markets to support their currencies. It's thinking in terms of whether other currencies are really going to be a rival to the dollar or not. It's really important to think about what are the things that sort of drive a global currency. And in many ways, the factors I'm going to talk about are just sort of macro versions of the micro factors I talked about, like medium of exchange. For instance, the share of world trade and output. Well, of course, trade is driven by wanting to make exchange. So, of course, share of world trade and output is a good proxy for global medium of exchange. And microeconomic and price stability really is fundamentally a proxy for whether it's a store of value or not. And the depth of financial markets plays a very big role in currency demand. But again, it's for a medium of exchange in terms of if you think about financial markets. And again, these tend to be very large markets compared to commodity markets. But if you want to, for instance, hold U.S. Treasury bills, which are looked at across the world as a sort of the safe haven asset, you need to have dollars to buy them. And so, of course, that means that raises the demand for the dollar. And of course, there's always some sort of network effect. It's much easier to trade in a currency if other people are accepting those currencies, which means to some extent having that incumbency advantage is very important. And I think it will be incredibly important for the U.S. In that while I think the dollar has peaked in some extent in terms of its usage, not necessarily its value, there will be a long sort of incumbency effect that drives that and keeps us in place for a very long time. Now, the fact that the dollar is the #1 global reserve currency, why do we really care? I mean, what does that do for us? What are the advantages of that? The most immediate advantages is it lowers interest rates in the U.S. There are a number of estimates. Approximately about a percentage point is what's accepted is kind of the consensus estimate. It also allows us to issue debt in our own currency. Many other countries around the world do not have the privilege of issuing debt in their own currency, and so that entails lower hedging costs. It also entails a reduced potential of default. Much of what drove the Asia crisis in the 90s was the fact that most of the external debt of these countries was not denominated in their own currency. So when they suffered devaluation of their currency, it raised the value of the debt they owed, which really pushed them to insolvency. So at least for the United States, we're never going to become insolvent because of the decline of the dollar. We certainly might end up with a point where nobody else wants to continue to lend to us, but again, there's a tremendous amount of advantage to having a global currency. Now, you are, of course, subject to some capital flight, and you also give up some ability to manage your domestic economy. And of course, it's also important to keep in mind that having a strong currency is a double-edged sword depending on how you look at it. Depending on having all this upward pressure on your exchange rates, of course, makes a stronger dollar, but we're going to come back and talk about how that affects different industries differently. Let me talk potentially about, and I'm going to put off to the end of this the current situation with the euro, but let's just say, looking at the very basic measures of what makes a global currency, what are the prospects for the euro? And I've got some comparisons here between the U.S. and the euro area. And again, the population is very similar. The euro area is actually larger. GDP, it's a little lower, but it's certainly comparable. And in trade, certainly the euro area actually has a far greater international trade impact than the U.S. So in terms of a medium of exchange, tremendous demand for the euro. And again, this is one of those things that will help the euro, if it survives its current crisis, will help it become a rival to the dollar in a very real way. Now, one of the things that lessens that demand is that the euro area simply does not have currently the amount of financial sophistication in terms of financial markets as does the U.S. And this is, of course, when one excludes the U.K. from the euro area. For instance, what I've offered is a geographic concentration of sort of market turnover in the derivatives market, both interest rate and foreign exchange derivatives. And it really is apparent that the U.S. and the U.K. essentially dominate the derivatives markets. New York and London really have such a big footprint, and if you want to play in those markets, if you want to hedge in those markets, you really need to have dollars or you need to have sterling. There are a few other exceptions, but you can see from the numbers in the table that despite whatever they might want to believe in Frankfurt or Paris or Milan or even Tokyo, their footprint in the world derivatives markets is just very small. And of course that may come to change at some point, but again, because of the huge importance of the financial markets in the U.S. and the U.K., that has restrained the ability of the euro to compete with the U.S. to some extent. Also, a big demand for any currency is if you're going to issue debt in that currency, and a number of countries, of course, issue debt in currencies other than their own. And so, again, if you want to be able to purchase that debt, you need to be able to have that currency to buy that debt. And so what I've listed is, to some extent, bonds and notes and money market that are issued in various currencies. And the middle column is a sort of percent of own to give you some sense of how much you see in how much you see in this currency market. And so in a number of, for instance, one of the things interesting to look at is for the pound, when I have 167% listed, what that implies is that there's far more currency issued in pounds than are actually issued by the UK. And so you see a number of currencies that have that fate. And of course, there's some interesting examples like the Australian and Canadian dollars where they issue relatively small amount of debt themselves, but a number of other countries will issue debt in their denomination and try to take advantage of that. And again, you see this as a very large percentage of the marketplace. And again, it's important to compare the second column to the first because, for instance, the Swiss franc, which has tended to be, the most stable fiat currency, is a small amount of debt itself. It's a relatively, in terms of Europe, it's a relatively fiscally conservative country, and the fact that that 1.5 compared to 7.2 gives you a sense of that. There's almost 6 out of 7 of debt that's issued in Swiss francs is issued other than Switzerland. So it tends to be a number of countries do issue in that marketplace and peg to that currency. To give you another example of demand for the dollar, when it comes to global equity markets, really nobody competes with the U.S. in that way. As I mentioned earlier, London has a very big footprint in derivatives and other types of trading, but the U.S. far dominates. And again, it's hard to see this changing anytime soon. Even if you combine London and Paris and Frankfurt in Milan and combine those stock markets, they would still be smaller than equity trading in the U.S. Now, of course, this is also a difference in that U.S. corporations are far more dependent on equity markets relative to European corporations, which are far more dependent on bank lending. But again, having that demand for your currency because people want to buy into your equity markets, it's a very big important driver of the health of your currency. Now, obviously, I mentioned earlier the prospects of you want this to be a stable store of value. This is actually one of the things that the euro has got going forward. Is since its introduction, the inflation rate in the euro has been on average lower and more stable than it's been in the U.S. So even despite recent movements in the euro, recent weakness in the euro over the last year or so, you certainly have still seen the euro be a relatively better store of value since its introduction than the U.S. And that also holds in terms of exchange rates. So again, and this is effective exchange rates against a weighted basket of currencies, not simply against the dollar. So again, the euro has the size to compete. We're going to talk to a second about stability. It has some of the financial depth, but the real wild cards in terms of if we're looking at 20 or 30 years from now, whether the euro will be a rival, will be what do those outside the euro do? And of course, it's hard to imagine any of the more established countries, developed countries like Britain or Switzerland, deciding to join the euro area. If at some point in the future they did, that would absolutely change the dynamic in a way that would increase the demand in the depth of their financial markets and could potentially make the euro the dominant currency in the world. That said, again, I would emphasize it's hard to envision the UK or Switzerland wanting to sign up to anywhere like that now. But I would emphasize, what could happen in 20 years is anybody's guess, depending on how the current situation moves forward. Now, of course, if we see some sort of euro bond, there's cuts in both different ways. One of the reasons I think that you see such a reluctance and demand for the financial markets in Europe is because they're so fragmented. I mean, yes, they're all denominated in euros, but they tend to have very different credit risk. Obviously, there's very different credit risk between Greece and Germany, but a euro bond would essentially have a standardized credit risk in a much more liquid market, which would increase the demand for the euro. Now, the other side of that would be raising the specter of whether those deficits actually get monetarized and get covered via via the printing of money. And of course, if that was the case, then you start to have questions about the value of the euro in that regard. So again, it's hard to say at this point what the net effect of that would be. There's some parts of that would increase the liquidity, increase the demand for the euro. But on the other hand, if you don't see fiscal discipline come along with it, then I think you would see some reason to suspect that it might undermine the euro. Now, I'm of the opinion that I don't really think anybody is going to leave the euro. I don't see Italy or Greece, Portugal or Spain actually leaving the euro. And I will emphasize nobody has a real crystal ball at this point. I partly say this because the argument for them to be leaving the euro is so that they could essentially go back to their own currency and essentially print away their debt. But if their problem today is accessing the capital markets, I think it's reasonable to assume that were Greece, for instance, to go back to printing drachmas, nobody in their right mind is really going to lend to them except at very exorbitant interest rates. So again, leaving the Eurozone does not solve their problems. They still have deficit finance and they still have to fundamentally deal with their fiscal imbalances. And leaving the Eurozone doesn't necessarily solve any of that. Now, of course, I do think that leaving the Eurozone for some of these more troubled countries would actually strengthen the euro, were Greece to actually leave the Eurozone, were Italy to leave the Eurozone, and you simply had a core countries of Germany, France, and a few Eastern European countries. I think you would have actually a stronger euro come out of that. But again, it would be a much smaller trade footprint. So again, we'll have to see how the next 2 to 3 years actually work out, because I'm under no illusions that Europe will get its act together anytime soon. But how they get through this crisis will determine the role of the euro, how big of a footprint it is, how much of a rival to the dollar it is. I'm happy to go into a little more detail in Q&A, but I'm of the opinion that the euro is going to be here to stay in one form or another, at least for the next couple of decades. It really is a matter of who's going to be in it, and less a matter of whether it's still around. But let's think about the other potential rival to the dollar and why they matter, and that's of course the Chinese currency, the renminbi. They've obviously got the population. They've got a very large GDP that in real terms rivals the Eurozone. The one thing that's sort of holding them back now is relatively small amount of trade. I mean, it's obviously very large, but compared to the trade involvement of the U.S. or the Euro area, it's small. And of course, the other things that are going for it, however, is the central bank there is very committed to having a global currency. And we've seen this in a number of efforts to try to get, you hear things like the dim sum market where bonds are floated mostly in Hong Kong, Singapore that are denominated in renminbi. You see a tremendous more amount of activity in the Hong Kong banking system, for instance. So China has a plan to globalize the renminbi. There's certainly no doubt about that. The question is how quickly can they do it, and we're going to come back to that in just a second, but there's a plan there. And as I mentioned earlier, talking about some of the trade flows and that are denominated in dollars in Asia, if you really see a move toward, and I think one of the most underreported events over the last month or so was an agreement between Japan and China to start pricing some Japanese trade with China in renminbi. And again, if you see Japan agree to this, and again, it's hard to say whether this will be the beginning, but I think a Asia monetary union 20 years from now would not be out of the picture at all. And again, if you could pull in China, Japan, and Korea, Vietnam, and other countries there, you could certainly come up with a very dominant trade bloc that had a very big monetary influence on the world in a very big way. But again, my opinion would be we are 10, 20 years away from that minimum. But part of his looking forward, of course, is that, as I mentioned, China already has a very big economy, but they are projected to grow even bigger and to become even more dominant share of the marketplace. And in real terms, certainly are projected in not that long, by 2013, to overtake the Eurozone, and they've already overtaken Japan barely. So again, moving forward in a way where they're becoming a much bigger share of the world economy is something that's going to increase the strength of their being. There are a whole lot of reasons, however, to be very skeptical of China anytime soon rivaling the dollar in any real way. Their banking system is very weak and non-transparent. It certainly seems like to me that they will have a number of bank bailouts of their own, whether they do those through printing money, whether they do those through nationalizing the system already more than it is. It's hard to say at this point, but there's so many uncertainties with their banking system that I'm not sure that anybody in their right mind would really leave a lot of their, in terms of somebody outside of China, would leave a lot of their money into the Chinese banking system without some promise of very high return. Another problem, I think, fundamentally with the Chinese currency is their central bank is actually driven, dominated by the Communist Party. The governing council actually makes interest rate decisions and dictates those to the central bank to be made. So, we're used to in the U.S. having, at least the facade of Federal Reserve independence. There's not even that in China. It's a very driven process by politics. And given the what will soon be leadership changes in China, you could easily see a shift. And if politics shifts in China, then I think that you will see a shift potentially in the currency there. So again, the fact that there needs to be a political commitment to having a strong currency in China for them to really be able to rival the dollar, that could go away. And of course, to try to establish very deep capital markets, very deep financial markets, you need protection of contracts and property rights, which I think are currently lacking in China. And of course, I'm going to come back and talk this a little bit more in depth, but political instability is a very big driver historically of currencies. And again, I'm going to talk this more in depth, but Asia is certainly probably the hotbed of the world with the Middle East, where political uncertainty is. So all you would need for the Chinese currency to crash is a few missiles shot over Taiwan, and people get a little nervous about that. And again, so whether we see the flip side of this, that is the China grows bigger in the world and its currency becomes more dominant, whether that means that they will be less likely to want to see political instability in that region and recognize a trade-off for that, I think is an open question, but certainly an important one. And again, heavy reliance on capital controls and internal finance in China, which really makes me think that they are, again, a number of years away from being any sort of rival to the dollar. Now, an important part of this as well is a number of other countries are starting to move toward being able to issue their own currency, issue their own debt in their own currency, which again, the fact that most of them issue it in dollars today will be a move away from that. And again, as other countries start to issue debt in currencies other than the dollar, the demand for the dollar will fall. So we've really seen a very big change in that over time. As I mentioned in the PowerPoint, pre-World War II, there were really only 8 countries that could issue issue debt in their own currency pre-World War I. Everybody else, you either were issuing in pound sterling or French francs or U.S. dollars. And today we've got at least 25 different countries that on the London Exchange issue debt in their own currency. And I think that that's only going to grow to that extent. So again, most of those countries have formerly been countries that issued their currency in dollars. So seeing that decline for the dollar will, of course, end up reducing the demand for the dollar. So it's always worthwhile to go back and try to find parallels in history, keeping in mind that, of course, these parallels have their limitations. But the question is, really, is the dollar the new sterling? There certainly was a time 100 years ago nobody would have thought the dollar could have overtaken the U.S. and that sterling was going to remain, the dominant currency for quite a time. And again, it's important to keep in mind that those things actually happened quite quickly. And of course, sterling did not always rule the world. I find it interesting that from about 1500 to about the time of the American Civil War, the most important currency in the world was the Mexican silver peso, and really had dominated world currency. And again, what you really saw the change in terms of a move from a silver standard to a gold standard was the Industrial Revolution, which expanded British trade, which happened to be, for very arbitrary reasons, on a gold standard as opposed to a silver standard. And you really saw, for instance, countries switch in that way. And you really saw, again, the growth of what became a sterling area when you had countries such as India at that time, being British colonies, also switched from sterling to gold because of those relationships. And the ultimate breakup of that was, of course, the Cold War was a breakup of the sterling area. But again, World War I, World War II were very big changes in this. But you also see these internal choices. If you want to sort of think of this as a public choice argument for monetary stability, it's always a trade-off between sort of creditors and producers. One of the reasons, for instance, that the UK came back on the gold after World War I was the desire to maintain their dominance in the financial markets. And the sense was if they didn't come back on gold, they would lose a lot of their dominance, and ultimately much of that would flow to New York. And of course, when they left the gold during World War I, New York took a great advantage of that and gathered a tremendous amount of share of the world financial markets at that time. Of course, there's always the belief among the exporters in a country that having a cheaper currency would help exports. And again, you do see this push and pull, and the stronger you have a country's a grounding in financial markets, the more stable currencies you tend to have. And of course, the choices are always, what is there to choose from. We had a window of time and window of opportunity, in my opinion, during World War I, where the U.S. had made the right choices in terms of trying to offer an alternative to sterling at the time. And again, it was a matter of both luck and opportunity. One of the reasons that the United States has gotten away with, relatively reckless monetary policy since the end of the Bretton Woods era is because there hasn't been a whole lot of other choices. Certainly during the last pre-Euro, post-Bretton Woods, pre-Euro, of course, the Deutschmark was a very strong currency, and so was the Swiss franc. But at the same time, it was always hard. Neither one of those countries had the size of the capital markets, the size of trade they need, not to mention that there was always going to be an overhang with the Deutschmark that, essentially when you had Soviet tanks on the other side of the wall, there was always going to be a worry about how stable that currency always was, not to mention that there was never the creditor-producer balance that I talked about that you've seen in the UK and the US that would have supported, making the Deutschmark that much of an international currency. So, you need to have a lot of those things come together to get that sort of price stability, not to mention support for alternative currencies in that way. And this is just to give you a chart illustrates some of the differences between that really back and forth fight between sterling and New York. Happy to talk about that a little more in Q&A, but one point I really want to make, which is, you go back and you look at history, and one of the biggest drivers of whether currencies stay on top or not, ultimately conflict and war. And it's fascinating to look back and see what are the drivers that have created financial markets. For instance, it was really Napoleon who basically forced capital flight out of Europe to the U.S. that created the U.S. bond market, and really saw a lot of gold flow to the U.S. in that regard. And the U.S., of course, rose to dominance both as a country and of the dollar because of disruptions that occurred during World War I and World War II. And again, I keep raising this because these are things that are going to, change the course of currencies as we go forward, and why I certainly hope for a conflict-free world. I think one has to keep in mind that these possibilities can change things. As I mentioned earlier with China, certainly Asia is an area of tremendous potential instabilities that could really change the course of whether the ruble is a dominant currency or not. On the other hand, one of the things that I think will absolutely keep the euro together is if you talk to you talk to thinkers in Europe, the euro is really looked at as a way to bind Germany and France and the rest of Europe together. And even, I think, when the euro, one can debate whether it economically makes sense now, but that aside, one has to see the euro ultimately as a political decision more than an economic decision. And even when the economics no longer make sense, there is that sense of trying to keep it together. Now, the wild card question in my mind going forward is that, the newer generation of leaders in Europe are not necessarily the post-World War II generation. It really has been that post-World War II generation that has been absolutely committed to maintenance of the euro. So as we see younger leaders rise, particularly in Germany and France, whether that commitment is still there or not, I think is going to be an open question. I certainly think it's going to be lessened. So I could certainly see 10 years from now people in Germany feeling a lot less committed to the euro than they do today. Now, again, we're not necessarily, none of this is necessarily written in stone, but there's some questions that we want to do if we want to save the dollar and we want to try to make the dollar, continue to have the dollar be the dominant currency. And again, I would say that I don't see it disappearing, keeping in mind the measure of central bank reserves where the dollar is about 2/3. The question is, the things that we can do, whether we slip away from having 2/3 down to 40 or 30% of reserves. But the most important thing we need to do is address our long-term fiscal imbalances. If we raise that specter that we're ultimately going to print money and monetize our debt to get out of our problems, that of course is going to simply destroy the dollar. And of course, increasing domestic savings is a big part of that, where you do increase the demand for the dollar, where you give some sense of that we're essentially dealing with our own problems. Now, other parts is to try to anchor the dollar in sort of rules versus discretions that's known in monetary policy. One of the reasons why we saw in the late 70s and early 80s a lot of discussion in the U.S. over alternatives to the dollar, such as bringing back a gold standard, is because of what I would say is very poorly done discretionary monetary policy in the 70s. And for good or bad, essentially I think what squashed that movement to some extent was Paul Volcker getting appointed to head the Fed. And once you start to saw the Fed get serious about inflation, much of the public interest in alternatives such as the gold standard went away. So I certainly don't see Ben Bernanke becoming a Paul Volcker. So the question would be, at some point, do we have a Fed that decides that maybe focus on price stability and worried about inflation, or do we see a Fed that decides that the emphasis is going to continue to be on some sort of unemployment lever? And of course, some of the other opportunities to anchor the dollar would be peg it to a commodity, whether it's gold or whether it's a basket. I actually think this is one of the areas where China has the greatest opportunity. They are probably the only country in the world today that has such a large store of metals and other commodities that they could probably float an international currency backed by some sort of commodity and do that in a credible way. Certainly the U.S., it would take such a change that it's hard to see that come about. And of course, there are halfway measures between hard rules and discretion, and of course limiting discretion such as mechanisms being inflation targeting or eliminating the Fed's dual mandate of price stability and unemployment might be some way to try to bring some more credibility back to the dollar as a store of value. But all of those things are open potentialities that may or may not come about. It's important to keep, let's think about, let's keeping the assumption in mind and the forecast in mind that the dollar in terms of usage has peaked, and we're going to be sharing the world stage, whether we share that world stage with China, the euro, or whether we share the world stage with Bitcoin or some sort of alternative. This is going to have some changes on the dollar. First of all, in terms of who wins. A weaker dollar in this regard from reduced demand for the dollar is going to help U.S. exporters, potentially agriculture, manufacturing, anybody who's really also competes with strong foreign presence, such as the auto manufacturer in the U.S. And of course, financial services that depend on savers, because this will force up interest rates in this country, which will increase savings. So some domestic financial services, of course, will benefit from a weaker a weaker dollar, less demand for a dollar. The other side of it is who loses, because of course this will push up interest rates. So we have a number of sectors in the U.S. economy, such as construction and business investment, durables, that tend to be very interest rate sensitive, and so higher interest rates from a weaker dollar would hurt them. And of course, higher interest rates on U.S. borrowing would put downward pressure on the ability to run ever larger deficits, which would ultimately mean that we would be having less government employees. And of course, there are a number also of financial services components that are dependent on low interest rates, such as mortgage bankers and others that are tied to the real estate industry, that would lose essentially from having higher interest rates going forward. And that, I guess I should emphasize and maybe make it a little bit clearer, that one of the outcomes of a weaker dollar ensuring the world stage would be higher interest rates in the United States, which of course would have some impact on encouraging savings and encouraging investment, and would, in my opinion, help steer investment away from just asset bubbles into maybe longer-term investment that might actually increase productivity. So before we start opening to the questions, I just want to leave you with, essentially the uses of the dollar is peaked. It's going to be in our hands, what that looks like going forward. Regardless, we're going to see a reduction in borrowing costs, and we're also likely to see the return of something called interest rate parity, which every other country in the world lives by except the U.S. And what that means is your cost of borrowing often reflects what expected inflation is going to be. So, for instance, if someone was going to lend to the U.S. at 5% and expected 0 inflation, but if they were expecting 10% inflation, they would charge us 15% for the same rate of return. The U.S. has largely been able to get away with being subject to that, where every other country has been. So at some point, not in the near future, but in the midterm, I think we're going to start being subject to that as well, which will start to discipline our own ability to borrow. And I will leave you open up to questions with the thought of ultimately fiat money is only as good as the politics that are behind it.
Okay, well, thank you so much, Mark. And to all of our participants, please type in any questions into the question box, and I'll go and I'll read them out to Mark. It looks like we have our first question already. If Iran closed the Strait of Hormuz, how would the flow of oil being closed to Europe affect the dollar in the world market?
I mean, that's a really good question. I think it would depend on how long it was closed for. I mean, if we saw short-term disruptions, then I think that would be one thing. But the fact that, for instance, that the oil, it tends to be priced in dollars, and it's also important to keep in mind many Middle Eastern countries have been looking to move away from the dollar. And of course, Saudi Arabia was something that complained about this in the 70s and 80s, and they complain about it now. I think that there will be a longer-term shift in the Middle East away from holding such high concentrations of the dollar and to move more toward a currency basket anyhow. So the short-term impact and probably the long-term impact would be weaken the demand for the dollar, raise the price of oil, and push up interest rates.
Okay, our next question is it politically plausible that the U.S. dollar could be pegged to a basket of commodities or currencies?
I would say in current circumstances, and I'm somebody who's in favor of this, but it doesn't look like to me that you've got, I think the political support needs to be there for it. I think you have growing support and skepticism about the Federal Reserve policy, and so again, I think putting that out there is something that's a positive. But I'd put it this way: I think it's going to have to get a little worse. I think certainly much of the public doesn't see the level of inflation that's out there, even though much of the public does. And of course, it also depends on, as I mentioned earlier, whether we have a new Paul Volcker that comes from somewhere and decides that all of a sudden he's going to worry about inflation. So, I would say we're getting closer to a sense where we're at a tipping point in support for that, but I don't think we're there yet.
Okay, our next question. How can you back a currency backed by gold if there's not enough gold in the world? What are other commodities that are good for currency backing?
Well, first, let's keep in mind that it really just depends on what you set the level at. I mean, arguably, if you set whatever your currency is to whatever the amount of gold is that's out there, prices would adjust. And of course, we couldn't. I think if you went back to something where pre-Bretton Woods, when Nixon took it off the gold standard, it was $1 to, you know, you couldn't do that without having deflation. But you could certainly set it to where an ounce of gold was not $35, but where an ounce of gold was $1,600 or something like that, where you did clear the market. So, but that said, you know, any sort of commodity basket could include things like silver, could include things even like, I mean, copper was a commonly used currency at one time for very small denominations. And of course you could, and also use food products as well. The reason that coins were, of course, used, metals were, of course, used, were easier to trade, but any type of commodity that can be stored, you know, you could have some sort of like warehouse type slips. So I think it would be possible to have a basket. My apologies, just getting over a cold.
Okay. The next question. What do you think about debt-free and interest-free currency?
Did you repeat that again?
Yep. What do you think about debt-free and interest-free currency?
Well, to the extent certainly most fiat currencies are today interest-free. You know, you certainly have had currencies in the past that have paid interest. And so I think if you had more competition in the marketplace, you could have that as an alternative, whereas an inflation hedge, a currency was offered that paid you some rate of return to head against that inflation, or also paid as, you know, as a way to get you to buy that currency, use that currency relative to some other currency. So I certainly think in a competitive marketplace, you'd probably have some alternatives that would arise where some sort of interest was paid on the currency.
Okay, next question. How would you see a migration from fiat money to a commodity-backed currency in the U.S. playing out?
This is something we actually spent a lot of time thinking about at Cato, and don't necessarily even trying to think through the different mechanisms. I think what you need to have is something that would be pegged in dollars that would be convertible, and so that you could ease. I don't think you could, you know, you'd have to have something to try to ease the transition in a way where people were still using the dollars and numeraire, but you're keeping the store of value basically is in gold or something like that. And one of the things that makes me optimistic about some of these things is the growth in sort of electronic payment systems. So you could easily see a credit card where the numeraire is in dollars, but it's ultimately backed by a count of gold somewhere or a commodity basket, and these already exist. And so this would be the first step of getting to having that backed in some way or another. And of course, you need to establish the credibility that just because you issue me a piece of plastic and tell me there's some gold somewhere back in it, you know, that I've got some credibility and I trust you, and those reputational problems are solved. But I think that those are all solvable. And of course, again, you could ideally have a world where I pick a commodity basket myself that's backed, and then again, it's in the numeraire is in the dollar. You know, so to some extent, the important part is trying to keep the store of value, whereas the numeraire, I think, is less, you know, is less important. So I am optimistic about the ability of technology to try to help us sever those two in that way, and of course, trying to come up with something through that technology. So you're setting up the numeraire or the basket, you know, however it was focused and however it was customized to what your needs are, I think was something that could be quite effective. So I do think it needs to build off of the existing system in some way while offering some competition to the existing system. And maybe having this done internationally is something that can make the most sense. As I mentioned earlier, to me, probably the most effective way this could happen would be for China to issue a currency backed by commodities. And I say that because, one, they have a tremendous storage of they have been buying metals. They've been I don't want to use the word hoarding, but they have been making very large purchases of commodities around the world. Granted, a lot of that is, of course, for industrial uses that they have planned. But again, they have a large store of commodities. Their currency is only so internationally active. And I think the first step would be, how do you take that currency to make it internationally active before you could make it domestically active? So again, these are some of the things I'm trying to think through and trying to figure out how we come up with some alternatives. But again, I think you need to build off some of the features of acceptability with the current system so that you can ease people over in a transition.
Thank you, Mark. Our next question is, a constant inflation rate of 2% is typically considered healthy for the economy. Is this true and or sustainable, and does it reach a breaking point over time?
You know, I guess I'd say it's one of the things that sort of makes me pull my hair out when I listen to the economic commentators, because you do hear this assumption that 2% is somehow price stability, when of course it's not. I think off the top of my head that at a 2% rate of inflation over 30 years, half of your investment is gone. So it's certainly not any extent price stability. Now, economists will argue over whether the CPI number, the Consumer Price Index numbers, accurately represent inflation, and so there's some arguments that it overstates inflation because of, quality controls. If you think about the Moore's law when it comes to computer capacity, so there are a lot of debates in this regard, and of course, there's an sense to which I think a number of economists would tell you that having some low level of inflation, quote unquote, greases the gears. I don't necessarily agree with that. I mean, I would much rather see, if the Fed was going to set an inflation target, I'd much rather have it closer to 0 than 2%. So I will continue to be frustrated that I think the media and the Fed has sort of won that argument in terms of the public mind, but it's certainly worth pointing out that 2% is still inflation and still erodes the value of your wealth over time, and not to mention, it still distorts the price system. And I want to emphasize this is a very important component of inflation. It's not simply that you're losing the value of your wealth. It's also that inflation changes relative prices. And of course, the relative prices are incredibly important for us making the decisions about what to do with our lives, what to buy, what to do for a living, what for produce to produce. So when inflation distorts relative prices, it reduces the efficiency of the economy and makes us all poorer. So even at a 2% rate of inflation, you're still going to get some of those distortions in place.
Thank you, Mark. Our next question. A lot of people have raised the specter of a U.S. default resulting from a major spike in interest rates that makes it impossible for the Treasury to refinance debt. Is this a legitimate concern at the current time?
Well, I would first start with, it all depends on how you define default. And I mean, you look at Greece now. They're going to, bondholders in Greece are looking like they're going to take a 70% haircut. That is, they're going to get 30 cents. I mean, 30 cents on the dollar, 30 cents on the euro, if you will. Yet that's not being called a default. So, so again, it's kind of definitional. I would also say that if I borrowed $10 from you and inflated and paid you back in what was nominally $10 but was in real $8, then that's a default too. I would have to say that looking at the long-term fiscal situation in the U.S., we have three options or a combination of these three options for dealing with a long-term fiscal situation. One is to drastically cut spending. One is to print our way out of it. One is to raise taxes, which I don't think is actually possible to raise taxes enough to cover it. And I look at the printing of money as some sort of default. So quite honestly, I think we're going to see some level of default via debasement. Whether it's an outright default, I don't think that's going to be the case, because in the statements that you often hear that the U.S. can't default because our debt's in dollars and we can print dollars, well, that's technically true. We will always be able to print enough dollars to pay off existing holders of U.S. debt. The question would be, will they still lend us money after that point? And I don't believe they would. At some point, we've debased it enough that no one's going to lend us money anymore. So I guess I'd put it this way: we have a reckoning coming at some point. I don't think there's any way around it. Either we're going to cram down our promises we've made on entitlements. My guess is that we're going to do some combination of all of the above. No one's going to get all the Medicare, Social Security they were promised. No one's going to get 100 cents back on the Treasury debt they've lent, but it's going to get debased away. And There are going to probably, unfortunately, be tax increases. All those things are probably going to be some combination of the above.
Okay, thank you, Mark. And let's see if we can do one more question.
Sure.
And that's all we'll have time for this evening. Do you think the U.S. will experience hyperinflation in the near future? If so, when?
Well, one needs just, of course, to define what one means by hyperinflation. The sort of 50%. I mean, the economists usually define hyperinflation as 50% increase in prices within a year or more. And of course, like 1920s Germany or Zimbabwe, you can have this where you see 50, 100% inflation in a day. I don't think we're going to get to that point in the U.S. I mean, I will emphasize, certainly you can't rule it out, but I think that the political system, you would see such a pushback. I think that at that point, people would be rioting in the streets to that extent before they would allow to see prices turned over that much. Interestingly enough, I think the American public is far more sensitive to inflation as a political issue than a lot of other people around the world, and I think it's just hard for democracy to sustain that level of inflation for that long. And granted, again, I accept that in 1920s Germany they had that level of inflation, and again, the economy basically broke down. So I don't see it happening, but again, I think what we're going to be looking at over the next 5 to 6 years are upper single digits, maybe low double-digit levels of inflation, where 2 to 3 years from now, 4 to 5 years from now, we start to see inflation running around 10%. I think at that point, and again, I'm setting aside, there are a lot of debates over how well CPI measures it, and if you go back, I mean, for instance, there's a shadow statistics website that recalculates them under the old formulas. Under some measures, we're already at double-digit inflation, and certainly in some commodities we are as well. Those are all very legitimate points, but not wanting to touch that just for the sake of the argument at the moment, dealing with the current construct of CPI as it is. Again, I think we'll be pushing low double digits, but I think at that point you really will see a very strong demand politically to do something. But on the other hand, one can be constantly amazed at the ability of politicians to choose the worst of two choices and to simply look the other way. So I don't think it's inevitable. I think it's whether we have hyperinflation or not is really going to be the result of the political system. So again, I don't think it's embedded in our current monetary policies yet, but I think it's important for people to make their concern, their issue aware of it.
Okay, well, thank you so much, Mark, and thank you to all of our participants this evening.
My pleasure.
And we apologize if we couldn't get to your question, but feel free to continue the discussions with other participants in the chat room or on the Facebook event. I hope you can all continue coming back to our webinars to learn more throughout the year. Our next webinar is next Wednesday, February 8th at 8 p.m. Eastern Time with Roger Koppel on how to succeed in criminal justice without really trying. To register for the webinar, please visit studentsforliberty.org. On a final note, shortly you will receive a follow-up email where you will find more detailed information about SFL and our next webinar. You'll also receive a survey to evaluate the webinar. Please take a couple of minutes to fill it out. It helps us know how to improve our programs and makes these webinars more interesting for you. And with that, I think we are officially wrapped up. Thank you again for your time this evening, and have a wonderful night, everyone.